All right, hi everyone. This is part 3 of retirement benefits. Where we've come before this, we've looked at what a severance benefit is. We've then looked at what happens when you receive a lump sum payout from a pension fund. Okay, so remember that's the once-off big payment that you get. We said it depends on why you are getting that payment, why you are leaving the fund. Are you retiring? Did you die? Are you permanently incapacitated? That is the good way of leaving the fund. Or was it due to divorce or resignation or some other reason? That's the bad way. Okay. Remember, we then said also if you do get money out of a fund and you do certain things with it, it will be allowed as a deduction. This is a bit of self-study. You need to look at paras 5 and 6 of the second schedule. That will list the allowable deductions that are allowed. It's going to be transfers from one type of fund to another type of fund that will allow there to be a deduction, and the net effect, you will not pay any tax now. That's linking in the whole purpose of the preservation funds that we spoke about at the beginning. Okay, but now what actually happens when we do get a payout? So when you get any kind of payout or when you get a severance benefit, it is going to be taxed according to the good table. Now the good table is as follows. Any amount that you get not exceeding 500,000 will be taxed at 0. Between 500 and 700, you're going to pay 18% on the first, or you're going to pay 18% on anything that exceeds 500,000. Okay? Above that, you're going to pay 27% on the portion between 700 and 1.05 mil, and anything above that, you're going to pay 36%. Okay? The bad table, on the other hand, has the same percentages, but the brackets are much lower. You're only going to pay 0 on the first 25,000. Then above that, up to 660, it's going to be 18, between 660 and 990, 27, and anything above that, it's going to be 36. So the brackets are the same in terms of percentages. It just means you're going to start paying tax on a much lower portion of cash. Okay. So this is if you receive money in a lump sum and it's due to retirement, death, severance benefit, ill health, something like that. This is if you leave the fund due to divorce, switching jobs, or any other reason. Obviously, you can see this is taxed at a worse rate, well, same rates, but the lower amounts are taxed. So this is known as the bad table. That's the good table. You'd much rather be taxed on the good table than the bad table. Okay. Some things I need you to look up on your own. There's definitions found in para 1 of the second schedule. What these are the definitions of the word retirement, retirement date, and normal retirement age. I want you to go and look up and see what these are. Find out for me what the normal retirement age is in South Africa. Okay. Just remember, as a little bit something special, where 2/3 of your retirement interests, this is situations in a pension fund or an RAF, where the 2/3 is less than 247,500, or where the person is deceased, you can take everything as a lump sum. Obviously, if the person is deceased, there's no point in taking it as annuities because the person is dead. So when you die, you can take everything, and where the 2/3 doesn't exceed 247,500, you can take it all in one go as well. Great. The reasons why you would have each of these tables, okay? The good table, retirement or death, certain types of severance benefits, okay? And then commutation of certain annuities, not something we're going to touch on. Okay, so these two, good table, if you retire due to retirement or death, or if there's some kind of a severance benefit, then you're going to be the good table. The bad table, any kind of divorce. Okay, we'll talk about this in the next slide. Bad table. Any other reasons for you withdrawing from the fund? Bad table. And let me go back there. And any transfers between funds as well. will be according to the bad table. But just remember, it's important because I'm going to make this big. When you have a transfer between funds, it's going to be as per the bad table. But if it's a qualifying transfer between funds, remember those deductions we spoke about earlier, you will have this amount being treated as a withdrawal benefit. But if it then goes into another qualifying fund, it's going to count as a deduction and your net effect will be 0. You'll only be taxed when it comes out of that fund. Okay. Remember, that's often the purposeful preservation funds of pensions or providents, because if you have to leave one fund, let's say you get fired and you can't stay part of that fund, but you don't want to get taxed on it, remember, you take it out, it counts as a withdrawal, but because you're putting it into a qualifying preservation fund, that'll be an allowable deduction, the net will be 0, and you're not going to have any tax now. You will only have the tax when it comes out of that fund later on when you retire. Hope that makes sense. Okay, so that gives you the reasons for the good or the bad funds. Then we need to talk a bit about divorce. Not a nice thing to talk about, but it is something that happens and we have to speak about the tax of it. Interesting story. I'm recording this during the lockdown for Corona, COVID-19, if you're watching this in later years. And very interesting, what China's just noticed, they've just let go of their lockdown and the divorce rates have skyrocketed. So clearly spending X amount of time with people in the same house either makes your relationship stronger or it breaks it. So they've seen records amounts of divorce. Now we need to think about what happens when you get divorced in terms of your retirement savings. How it now works is what's known as the clean break principle. So he, she, whoever you get divorced from basically gets half your money. It's pretty clean. But how it used to work is that the person used to have to wait until you retired and then they get half of your money then. How it works now is that they're actually going to get half of your money now. How we do this? Remember we said there's something called a minimum individual reserve? Well, that is the value that is in your account at any point in time. What happens is that spouse, when you get divorced, will be entitled to half of whatever that value is on the date that you get divorced. And it will count as a payout from that fund from one spouse to the other. Okay. Because you're ex-spouses, you'll obviously be taxed on your own tables. What will happen is the spouse that is receiving money, okay, will be counted as receiving this payout on the day of divorce. You don't have to wait until retirement. And then they have a choice what to do with that money. If they take that money and they take it as a lump sum, they get to use it, great, but it will count as a withdrawal benefit and they will be taxed. If they choose that they don't want to use that money right now, they'll keep it until they retire, they can take it and put it into a preservation fund, an RAF, whatever they want to put it into, and they are not going to get taxed. They'll only get taxed when they withdraw it later on. So they have the choice. Okay. So when you get divorced, half the money will come in, and you will then have the choice: do I take it, then I'm taxed on it, or do I put it back into some kind of pension fund, provident fund, preservation fund, and then you'll only get taxed on it later. Okay. Some things to remember: this 50-50 principle will also depend on if you have some kind of a prenup, then it may not be 50-50. Also, if each of the partners in the marriage has their own retirement funds, you'll obviously do a balancing figure so that they become equal or they end up in the right proportions. So you're probably not going to have a situation where each person's giving half to each other. You will just find out what the balancing figure is and transfer it as needed. Okay. Cool. Great. Now, this slide tells us the process of how we do the calculation of using this table. Now, what I would want you to think about is if the first 500,000 is exempt, what are some plans that you could come up with in order to use that to your advantage? Remember, we need to think, as my dogs are going crazy outside, a motorbike's gone past. What you need to think about is how could you use the fact that the first 500,000 is going to not be taxed to your advantage? So pause for a second here, think about it, and see if you can come up with anything. Now, maybe you came up with the following. Well, what you do, join a whole load of funds, put 500,000 in each, and then retire from each of them individually once a year. 500,000, you're not going to get taxed. Sounds like a really good idea. But here's the problem. These tables, both the good and the bad tables, are known as, I'm going to make it big, known as cumulative tables or lifetime tables. They apply to all the amounts that you've received over your life, not just once off. Meaning, if you receive 100,000 Rand as your first payment, it'll go here, it won't be taxed. If you then receive another, let's say, million, you are going to have to work out based on having received 1.1 million, not just the 1 million on its own. This is cumulative. It means that you add up. Now, that can get a little bit confusing because what if you are after payment 2 in this bracket, but then in payment 3 on this bracket? And what if your first payment was calculated based on the bad table, but your second payment was calculated on the good table? It can get a little bit much. Okay, so to look to see how we do it, this table summarizes what we need to think about. So here's how we do it. Place all of your severance benefits, your good retirement lump sum benefits, all right, and your bad ones in the order that you received them. Okay. Next step, calculate the current payout, the most recent one, whichever one it might be, good, bad, severance, whichever, and add to it all of the previous payments that you've ever received from all three of these. So you're going to sum up all of the payments that are subject to these two tables and add them together. Okay. Then what you do is to say, well, calculate the tax that is required on the sum of all of them on the table that you should be using for the current payment. So if the current payment, the one you're looking at, the most recent, is as per the good table, then you use the good table. If the current payment is as per the bad table, then you use the bad table. So you work out the amount payable on the sum of every one you've ever received. That is step number 1. Then, step number 2. Using the exact same table you were just using, work out the tax that would have been paid on every previous payment, okay, other than the current one. So take the sum of every previous payment, excluding the current one, and stick it into the table that you're using. Work out how much tax should have been paid on those. Then what you do, you take your answer to step 1 minus your answer to step 2, and that gives you the tax that you need to pay on the current amount. Basically, what you're doing is you're saying, well, if I work out the tax that I should have paid on all of my things, I take off the tax that should have been paid on everything other than the current. The difference will be the tax on the current. Okay, and why we have to do this is because we might have used different tables to calculate each value. You may have had some previously on the good table, some on the bad, may have been a mix. You don't know. So this amount in step 2 is not the actual amount of tax you might have paid previously. It's a hypothetical, which means not real calculation. But it does give you the amount that you'd have to pay on the current. So remember, add up everything. Okay, stick it into the right table that you're using. Add up everything other than the current payment. Work out the tax on it as per the current table that you're using. The difference between the two is the tax on the payment that you just received. I want you to go to the textbook and I want you to do some of these examples so that you can see how it works. It's also going to be in the tuts that I give you. You need to understand this process of when you get more than one payment from different tables.